Hello, everyone, and thank you for watching the next episode of AgentX Podcast. Today, I have a very interesting guest. Very excited to have him in the studio because he brings a ton of expertise, has just a lifetime of experiences in a realm that we are doing a series on, which is VC, PE, and M&A space. So I am going to welcome into the studio Sean Michael Murphy. Sean, how are you today, sir?
I'm doing great, Dan. How are you doing?
I'm doing amazing. Thanks for asking. Sean is the founder and managing partner of MedAx Capital, and they are an investment banking firm. He launched it in 2021. MedAx Capital positions itself as providing curated investment opportunities and advisory services with an AI-enabled infrastructure. Did I get that correct?
Yep, that is correct.
Awesome. Definitely want to dive into that. His professional background includes decades on Wall Street, which we talked off camera, and you have a really interesting story there, and I would definitely want to
hmm
share that. Um, and let's see. Yeah, you've been in trading and investment banking prior to starting at X Capital for years. In fact, if you don't mind, can you share a little bit of that story about how you got started? Because I thought that was very interesting.
Well, I got started at a young age. My mother would tell me stories. I grew up in New York, and not far from the New York Stock Exchange. My mom would tell me stories about working on the New York Stock Exchange. She was actually one of the first five women to work on the floor of the New York Stock Exchange in 1971, when
Mm,
most of the men were over, obviously, in Vietnam during the Vietnam conflict.
right.
She went on somehow to marry an Irish cop. So I was not born with a silver spoon in my mouth. She should have married, one of the founding hedge fund advisors back in the day, but that wasn't the case. But right after high school, I went into New York City. Again, I was about a half hour outside the city is where I grew up, and got a job getting coffee and running buy and sell tickets for two brothers that worked on Wall Street. And I was licensed by the time I was 19 years old,
Wow.
and the rest is Wall Street history. Here I am over 30 years later. I moved my family during COVID from New York City to Dallas, Texas, where we are right now. And when I made that move, I started MedAx Capital, and it is a platform that facilitates investment banking with a AI kind of flavor to it, if you will.
Yeah, definitely want to dive into that. Well, before we do, just give the frame and what the topic is. We are touching on in the spine of this podcast is rethinking due diligence, a fresh approach to risk assessment. That's where we're starting. However, I definitely want to know what you know about AI and where you think it's going in the future, because I've heard a lot of different takes on it could be the next tech bubble. If you remember 2000s when the dot com thing just kind of blew up. So I definitely want to dive into that. But before we do, when most people hear due diligence, they think spreadsheets, checklists, red flags. From your perspective, what does due diligence get wrong often in today's market?
In today's market, one of the big caveats pre AI would be that the diligence was just wrong, and it was wrong because of bad data that wasn't vetted properly by the investment banks that were doing the due diligence itself. Now AI brings a whole new kind of danger, and that is of hallucinations. Everybody that's listening to your podcast is very well aware that sometimes, in an effort to um, bring an answer to the table, a lot of these AI agents will hallucinate and make up facts. And that's
Hmm.
one of the issues that is facing people in the due diligence process that you just mentioned, that frankly hasn't been an issue until AI.
Huh. Okay. How has the definition of risk changed in your opinion over the last 5 or 10 years? You kind of touched on that, but especially as business became more digital and AI, it's moving faster, it's decentralized. H- What's your take on that?
There's definitely a lot more risk, and that's because things are moving faster. Things are not vetted, in my opinion, as diligently as they were previously. And the reason is because investment banks need to stay competitive with each other. And when things are moving as fast as lightning, you either move as fast and access the capital for your clients, as fast, or you're going to be left in the weeds. So, in my opinion, the diligence process isn't as diligent, to use the word twice, as it was going into AI.
Okay. And when it comes to your firm, who is your perfect client?
Our perfect client is somebody that is a startup that's somewhere between the end of their seed round or their A round. And the reason we lean a little bit closer to the A round is we want to see somebody with some commercial traction. However that manifests itself, as opposed to more of angel investing, which angel investing is, for lack of a better definition, a great idea on the back of a cocktail napkin. We want to see some commercial traction, some revenue typically, unless they are involved in the life science space, where you're not going to see any revenue until, in a lot of situations, you have an FDA approval or things like that. And at that point, the company could be publicly traded for years.
Yeah. In your experience, have you ever, had somebody come to you and you're like, wow, this looks like a great this looks like a great client. It's perfect. It looks great on Excel. And then you met the leadership team and you're like, oh, I
We
don't know.
have, we have. We've a couple of years ago we had that exact situation, and the way that we tabled it was we addressed it in a not an aggressive fashion, but we suggested they expand their leadership team with people with alternative talents, and they did. They brought in somebody to be kind of a co-CEO that had the talents that were lacking with the original CEO. Because you got to remember, Dan, being someone that's an idea guy doesn't make you a great CEO. The
Mm,
Mark Zuckerberg who comes up with an idea in his dorm room and actually can be the CEO of a publicly traded, multi-billion dollar corporation for decades. That's not something you typically see on Wall Street. If you look at most companies, the original founder steps aside somewhere either when they go public or within the first 5 years thereafter.
yeah, that's true. I've seen that play out a lot of different industries and businesses that I've been a part of. Same exact thing. And it seems also, well, one company in particular, I probably shouldn't name the name, but they've gone through several CEOs, right? Like they bring somebody in, they're there for like 2 years, they make their impact, they make some changes, and then they're out, and the next CEO is in. What causes that?
What causes that is that you don't know what you have until you have it, until you've got somebody in that position. And I think one of the best examples of that is, Disney with, Michael Eisner. They kind of keep him on the ready and bring him back whenever they need to.
Yeah,
That does happen with a lot of even Fortune 500 companies, and it only multiplies as you go further down the cap chain to newer startups, because at a newer startup, that CEO or whoever, whatever leadership position, typically the CEO position is what we're talking about, they've got to wear more hats the smaller the company is.
yeah, that makes sense. So when it comes to your business now, Sean, when you talk about AI infrastructure, how are you guys using it?
We're using it to skin a couple cats. First of all, if you look at companies that don't, there's been a lot of research that companies that don't get, most people think if a company doesn't get funding, it's because it's not a great company. We can tell you that about 10% of startups actually get financing, that are looking for financing, get financing from either private equity or angel investors or VCs. Okay, only 10%. There was a study done of the Inc. 5000 companies, which are the fastest growing companies in the United States, and they all make and to be on that list, you're definitely making several millions of dollars a year. So these would be considered successful companies. Only 15% of those actually got financing. So, if you've got 85% of them looking for money and not getting financing, and they're fast growing companies and they've got, millions in revenue, there's got to be more to it. And we've brought that down to, essentially three main causes. You have to have great management, obviously, and you have to have a great, MVP product. Okay. So those are two things you have to have. But after that, everything else is kind of variable. One of the things is the actual pitch itself. A lot of times great ideas die on the operating table because they don't have the management that can bring that pitch to life and get people, forget about writing a check. They can't get people to say, we'll take another meeting and deep further down the due diligence hole. And we're very interested. So that's the first thing. The pitch process is not effectively being mastered. The second thing is that a lot of people uh, go out to investor lists that they somehow acquire, and they're not going to suitable investors, people that are looking for what they're selling. And what we've been able to do with AI is aggregate all publicly available data, whether it's in Bloomberg, PitchBook, or Preqin, and we're able to find people that are writing checks in the size that we're looking for, in the business vertical that we're looking for, at the stage that we're looking for. So every pitch we get off is to a high quality lead. Okay. And the last thing is scale. Typically, if you work hard, you work diligently, you reach out to 5 to 10 funds or VCs on a daily basis, and you send out a well thought out email referencing previous transactions that they've done, and you do 5 to 10 of those a day. That's diligent work. We can reach out to between 200 and 300 a day using AI, because
Mhm.
AI can actually take that data that's publicly available and write emails that look unique. Okay. And they don't look generic, and they're sent out in scale and they get responses. So by using AI, we can go from, eh, presenting 10 times a day to 300 times a day. We can increase the quality of the person that we're actually going after, and the pitch process itself. So all three of those things improve your chances by anywhere between 15 to 20%. When you add them together, there's just no way you could compete with the traditional method, with what we've developed at MedAx Capital.
I like to hear that because I've been doing several of these podcasts. I've talked to a lot of people that are founders and in the same space that you're in. And it's kind of a mixed bunch, honestly. Some are very scared of AI or they downplay it like, it's the same stuff that's been around since the 70s. I literally had somebody say that. I'm like, I don't know about all that, but AI has been around since the 70s and the 80s. I'm like, well, maybe a version of it, but today's AI is more agentic, right? It's
Hmm.
autonomous and it can think and it can solve. Well, you have to constantly put in prompts and go, okay, let's try this now. Oh, let's try this now. You know, it's everywhere. OpenAI, Zapier, for example. I was building a thing in Zapier the other day, and Copilot. I said, this is what I'm trying to build. And what's really cool is you can sit there and watch it think. And I go, okay, I'm trying this now. This didn't work. All right, hang on a second. Let me try this. And you could see it solving itself and solving the issue. So I don't think it's the same. I do think it's going to change the way we do business. And there's going to be people like you, and there's going to be people that I have talked to in the past that are going to go to the wayside a little bit. I think they're going to be playing catch up when they realize that the power of it, and that's something that we do too. To your point, we deploy AI SDRs and cold email outreach. So within a few seconds, I can have 2,500 targeted accounts with 98% accuracy on emails, phone numbers, who the decision makers are, and then deploy my AI SDRs to do all the cold reach outreach for me. So typically, they're looking to get an appointment on my calendar. So that's not a cold call for me at that point. It's warmed up, right? And it
Hmm.
makes things move
Absolutely.
very, very fast. So I love hearing that. And I think and it is changing very fast too. Like trying to keep up with it is the biggest struggle I have found, because there's something new every single day. It seems like something's new's coming out. It's better. It's more improved. Um, what's your take? Like, where do you think this thing's going? Have you thought that far? Like, are we turning into like the Terminator age?
I definitely think we're going into an age that, very few people would be able to handicap, where we're going, how the story ends. I can tell you that, um, you know, AI is one of the only technologies, technological revolutions, the AI revolution, where the next iteration is actually smarter than the previous one. Okay. And it actually increases efficiency and profit margins. And what I mean by that is if you looked at previous, like the dot-com bubble, okay, you had massive capex in order to achieve more. At the time, they had a metric called eyeballs, more people looking at
Mm,
your website. Okay, um, this was all stuff that increased capex and increased the amount of investment that companies were making, and then eventually they didn't recoup it, so they were underwater, and we saw the bubble burst. With this, I'll bring up Amazon. Amazon, just last week fired 16,000 people, and they
mm,
fired the 16,000 people saying that they were able to replace them with AI. So
mm.
Amazon's margins actually expanded, their efficiency actually increased based off of their capex. Do you know what I'm saying? So,
Yeah.
you've got, that immediately becomes earnings. So it's not like the eyeballs theory where eventually we're going to get sales from those eyeballs and eventually those sales are going to become earnings. It's not like that with AI. Those earnings, that efficiency is felt immediately.
Yeah. That's a shame for the people that, they rely on that and their families. And I think it's going to change, you know, degrees. I mean, even like Elon Musk originally came out and he goes, eventually you're not even going to have to go to college. Like it's
Mhm.
just going to have to be really good with AI and implement it in your life. So people are going to have to be retrained. I think um, back when I was a kid, there used to be like a position for facsimile operator,
Yep.
fax machine. Like, and you could go to like an Ivy Tech and get a certificate to learn how to operate fax machine. Where is that today? Right? So it's like, I think
When
it's
I
gonna
was a
change the
kid
scope.
when I was a kid, ATM machines didn't exist. When they came out, they said bank tellers aren't gonna have jobs. Well, if you look at the amount of employees at JP Morgan Chase, when ATMs came out, the amount of employees is up like 6x. Well, because those employees, yes, you don't have somebody, you don't come in and take out $500 for the week that you need in cash, you go to the ATM. So yes, you don't have ATM transactions, but you've got much more sophisticated mortgage transactions happening,
Mhm.
and things along those lines. So the employee count at JP Morgan Chase has definitely increased since ATMs came out. It's just not the same job. So the facsimile operator job has gone, the way of the dodo bird, but
Yeah.
there are other jobs that have now come into play.
But you kinda touched on something a little earlier about the bubble, which I kinda wanna go back to if that's okay. But,
Sure.
the dot com and I don't know if I told you this, but, I actually started working at Morgan Stanley Dean Witter around 2000, right before the dot com bubble. And talk about trying to start in a very hard time. That was it. Right? Nobody wanted to
Mhm.
invest. That people you call people, and now and of course you know how it was back in the day. Like it was all cold calling.
Yeah.
So give you a big book and you're going through and you're just going through the thing and yeah. So I'm curious. This is like the next gold rush is the way I'm looking at it. The AI thing. It's everybody's trying to get into it. They're trying to figure it out. And okay, how do we make our mark in it? How do we make money? Nvidia is going nuts right now. So, do you think that it's perhaps a next bubble, or do you think that we've kind of learned from those things? What's your thoughts?
There definitely will be a bubble. The way that Wall Street, works is that, in my experience, is that the blue sky optimism and upside that's perpetuated by greed knows no limits on the upside. So you will see valuations get incredibly stretched. That's just the way Wall Street works. And then when the bubble bursts, you saw things like, Amazon.com was a $2 stock, they
Yeah.
oversell dramatically. On the sell side, we're going to see the same thing with AI. I can tell you this: the most recent adoption numbers that came out from Goldman Sachs is that small to medium businesses were around 11% adoption of AI. If only
Oh wow.
11%. You and I talk about AI all the time, so we're in an echo chamber. We believe everybody's on AI 24/7 because we are, and we
Right.
surround ourselves with those people. But I don't know if you go to the book club in Des Moines, Iowa, and you ask the guy that's got a successful chain of 4 pharmacies, 10 branches of pharmacies, how much AI do you use at those pharmacies? That's a successful guy. He's probably not using any,
Right.
so if you've got a low adoption rate, that tells me we're not in the eighth inning of this ball game. We're probably in the second or third inning. So we do have a lot more upside until that adoption rate becomes significantly higher.
Yeah. That's a good point because I assume, like you said, we're in this echo chamber and I get caught up in that. I find myself thinking, well, everybody probably knows how to do this. Or, I'm doing this. I'm like, oh, who's going to pay me to do this? Like it's so simple but it's not. It's to a lot of people, right? And you got to get out of your head and be like, no, like this is something that people will pay for to have done for them because they don't have time or they just don't want to, right? It's so, yeah, I get it, and it makes sense. I think that I'm interested to see where it's going to be in the next 5 or 10 years and the impact. But I do think that it's going to be it's a useful tool. Like I use the heck out of it. ChatGPT I use for all kinds of things. Research, knowledge. You still have to check it to make sure it's not just where it's pulling information from. But I think it's an awesome tool, and I think it's just going to keep getting better and better. Is speaking of like the human element and versus AI and spreadsheets, how do you balance hard financial metrics with like softer signals, like from a founder psychology, culture or operational discipline?
I think softer signals are the more important signals, because when I was going through the three things that are important for securing money, one of them is the pitch. That's kind of a soft characteristic. What makes up a good pitch? I've been selling securities and investments for 30 years, so I have a pretty good idea of what makes up a good pitch. Most people don't have, 3 decades worth of experience and can't do that. So that's kind of a soft skill that has to be developed over time as opposed to a hard skill that, you can type into ChatGPT and it's going to give you a definitive answer. 80% of the time without a hallucination that is in fact accurate, at least 80% of
Yeah,
the time. So I think the soft skills are actually going to be more important going forward because you can't ChatGPT those.
yeah, that's true. So that's where that human element comes in, right?
The human element is going to be important for things like bringing in business to firms like JP Morgan and other firms. If you're bringing in revenue and closing deals, AI is not going to replace you because it can't. Whereas if you are a research analyst and you do discounted cash flow analysis and comps for certain companies, that job isn't safe because, ChatGPT, Claude, they can all do discounted cash flow analysis and comps,
Yeah,
so you better find a different gig or you better find a different, a talent that you can bring to the table.
yeah, makes sense. So, is there ever you talked about decades of experience, and I know you have that. But is there ever like a gut feeling moment that you have during due diligence that you've learned never to ignore, even when like the spreadsheet says, "Oh, it's green, it's good," but you got that gut? Is there anything that you've
There
learned
are
like?
there are certain things. One is, employee turnover.
Mm,
That's something that, employee turnover doesn't necessarily impact the balance sheet. You can kind of, you know, make that work and make it not as expensive as it typically is. But it tells you something about the temperature of at that company if there's high employee turnover, especially at the higher levels. You
mhm,
don't want to see, a massive change. There was just an article about XAI, how eight of the original founders have left XAI, and they just did that merger with SpaceX, and it's going to be part of what will be the biggest IPO ever in history. Yet eight of the original founders going into the IPO have jumped ship. You know, that's not
mm.
something that you like to see typically.
Yeah. When is that scheduled to go IP? It wasn't in June, I think,
I'm
SpaceX or
sure if you could come up with a valuation that sticks at $1.5 trillion dollars, Elon would do the IPO tomorrow.
yeah.
They're kind of trying to get to that number. of
Yeah.
$1.5 trillion. It's more of
Wow.
a pricing metric than it is of a timing metric.
Yeah. Wow. There's been a lot of buzz about it, and it's going to create the most millionaires, or if you can get in on it at the right time.
Yeah. Yeah, we have clients that owns Twitter, and Twitter was acquired by XAI, and then XAI was acquired by SpaceX. So we do have clients at my firm that are going to be part of the SpaceX IPO because they were acquired in. So
It's
we are
awesome.
excited.
When you think about speed and pressure in AI, um, with compressed timelines and like competitive deal pressure that I'm sure you deal with quite a bit, how do firms avoid confusing speed with efficiency?
I think the results, efficiency is going to yield the results that you're looking for, whereas speed may not. It'll just increase the velocity and the work that's going on, but not the results. You've got to yield the results, and that's where efficiency comes in. And you want to yield better results with less economic output and also labor output. That shows efficiency.
Yeah. Yeah. That's I think that's going to be a more like a blurred line where people will get confused a lot, right? Because the speed they're thinking that they are efficient, but yeah, are you really? Is a big question. But um, yeah, that's interesting. So with your firm now, is there a certain direction that you're trying to move to in the future? Like, what's that look like for you? What do you
For
see?
us, it looks more, we're very client centric and very hands on with the personal touch. But we are going to rely significantly more on automation. We haven't traditionally relied much on automation, but we kind of need to, because if we don't, then we would have to scale up our headcount
Yeah.
significantly, and that obviously brings us into areas where the margins aren't what we're looking for.
What do you think when you say scaling up your automations? Like, what type of things come to mind that you would be comfortable automating?
Well, like first level client acquisition, like SDRs, like what you're an
Yeah.
expert in. That would be something that we haven't adopted that we definitely have to adopt, because having somebody on the front lines manually setting up appointments is probably a relic of the past, or should be a relic of the past, and it's not at our firm. We do have people that set up appointments.
Okay. You know, I have my own AI receptionist, like voice agents,
Hmm.
and it's my own brand. And I was playing around with the other day, and it's quite honest. I don't. Do you guys use one right now for your
We
business, or
don't.
is
We
it
don't. Like I said, we're deficient in that area.
okay? So it's so amazing how good it is now, and how human it sounds now. And I was messing with it because I was testing a new one. I named her Holly. She sounds great on the phone. She's very personal, and you really have to kind of slow down and be like, hey. And if you ask her, are you human or not? She has to tell you, I'm an AI, virtual assistant. But how good they are and how quick they are as far as like thinking on their feet. It's just amazing to me. And I was doing a little demo with my fiance the other night. I'm like, hey, I want you to meet Holly. So I called my phone number, and I was messing with it just to kind of, I was like, well, what if a rough customer comes through? How's she going to handle a tough customer, somebody that's not serious? Right. Because the whole purpose of it is to vet the client, to make sure that whoever's coming through is a legitimate lead for me and not just somebody screwing around. So I thought I'd put it to the test. I'm like, hey, business sounds good, but how about you and I catch up over a drink and we talk about it? And she very professionally handled it. She was like, I'm a virtual assistant and I am flattered, not saying no, but I'm saying not yet. Let's get back to business. And she brought it back. I was like, wow, I didn't even program it to say that. It just thought to do it.
Hmm.
Right. And had some fun with it. So I think, those kinds of things, the way it's going to be so hard to tell from human to AI, it's going to get better and better and better. I mean, they can think on their feet. They can use, ums and uhs and laugh, and it's going to be very difficult. But I think that as far as ethics go, as long as we keep it in check, will be just
Mhm.
fine, right? Like, hey, are you human? No, should never represent themselves as human in my book.
Yeah,
But I
I
think
agree with that.
ethics will
I think
definitely be
eventually
redefined.
you'll see laws and things like that come out.
They'd have
Right
to.
now, yeah, I mean, right now, I think it's just a best practice. It's not a law, but I'm sure that eventually you'll see more guardrails come out.
Yeah. So I know we've been talking a lot about AI, and I have one more question when it comes to AI.
Sure.
Um, Obviously, it promises faster insights. Where does technology genuinely improve due diligence, would you say? And where does it create like a dangerous overconfidence?
I think the overconfidence comes from, you know, the speed at which it brings it back, and again, I know hallucinations aren't, they're in the minimum. They're not, or the minority rather. They're not in the majority. But I think that you've seen examples in legal situations where people haven't checked hallucinations and things like that. So I think that that's probably the largest danger. But
Yeah,
even, if you do have to check every source, I mean, Daniel, think about what they're bringing to the table. If you have to put together a legal brief and your only job is checking the sources, I mean, that just takes 80% of the work off the table.
yeah,
I mean, you're just checking the sources. You're not actually going out and getting the sources, and you're not trying to remember them, or going to a senior attorney at your firm saying, "Have you ever heard of a case like this in the past?" And he's got to remember precedent.
yeah, yeah. Well, let's talk about post close reality, if we could, like
Sure.
redefining deal killers. If let's say if diligence were graded like 12 to 18 months after close instead of at its signing, what questions would firms ask differently?
Well, 12 to 15 months with AI, all those deals should be closed. You shouldn't have deals that
Yeah,
are that vintage, utilizing AI. I think most of the questions are going to be the same. I think that the only difference is going to be, again, checking those sources. I don't see most, because most of, as you know from your experience, at Morgan Stanley Dean Witter, the regulations really haven't changed that much over time.
yeah,
You've had settlement day when you started, it was probably, 7 day settlement for a trade. It's now, next day settlement. So you've got things like that. But the actual laws surrounding it really haven't changed all that much. As someone that took his
yeah.
exam, I took my exams 30 years ago. I still take every year the continuing ed exams, and I score very well on them because they haven't changed that much.
Oh, yeah.
With no selling, with no studying. So I don't think you're going to see that much change in. You'll see change in the duration of deals. They're going to be faster, significantly faster.
Are there traditional deal killers that you think are maybe overemphasized and risks that should stop the deal, but often don't?
I think that the biggest deal killer that should stop a deal and doesn't, would be the checking the veracity of data. Again, earnings and things like that. I think that a lot of red flags that appear on balance sheets, especially, aren't questioned as aggressively as they should be, because you've got to remember the people doing the due diligence are the people that are getting compensated when the deal consummates. Do you know
Yeah,
what I'm saying? So they've
yeah,
kind of got a vested interest in that deal happening, so it's
yeah,
very difficult to have, the fox watching the hen house, you know?
yeah. Are there other red flags that get you to sit up in your chair?
And the employee turnover obviously
Yeah,
is one. Another thing is, the management's general, um, ability to get things done. What I mean by that is, missing Zoom meetings,
mm,
missing physical meetings, not having prepared for client meetings or meetings with potential investors, things like that. People that run sloppy shows, so to speak, a
yeah,
sloppy business. Those are typically the red flags.
yeah. Makes sense. You start questioning how dedicated are they, right, in the success.
Well, how successful is that company really? Like I said previously when we were talking, about 10% of companies looking for funding get it. If this person's in that top 10% and they're running, a ship of fools, it doesn't sit right with you. As you said, it causes you to sit up and wonder, how is that even possible?
Yeah, makes sense. Let's say if you were redesigning the due diligence playbook from scratch for today's environment, what are the, let's say, three non-negotiables you would build into every process?
There would be guardrails in place, number 1, for, any type of data that was sourced using AI, um, or
Mm,
just any data in general, especially stuff that was sourced via AI. Number 2, I think the diligence process shouldn't be handled in-house by people that are looking to complete. That'll never change. The diligence process will always be done in-house, but it shouldn't. It just objectively shouldn't be done in-house by somebody that's trying to complete the transaction. And the
yeah.
third thing would probably be, you know, tighter checks and balances on the financial reporting. When you
Mm,
do start with new companies, as you probably know, new companies don't have as much transparency on their financials because they're newer startups. They're not somebody that uses a big six accounting firm. So a
yeah.
lot of them aren't as transparent as they should be, and those deals are typically kind of ushered along anyway. Like I said,
Uh,
you've got people that get compensated when the deal is consummated, so they're going to push the deal through.
one practical takeaway: if for investors or operators listening right now, what's one thing they should start doing differently in their next deal?
One thing that investors should start doing differently. Are you talking from somebody looking for funding or somebody that's a angel investor looking to give the funding?
Look, looking for funding.
If you're looking for funding, I think that you should retain somebody that is going to get your pitch down, number one. Number two, be able to get you in front of the most qualified check writers out there and most suitable for where you are, what stage you're in, what vertical you're in, etc. And then the last thing is somebody that can give you full transparency as far as what type of scale they've got outreach. Are you reaching out to 10 people a day? Or are you reaching out to 300 a day? Because it matters significantly. The
Yeah.
quality of your presentation, the quality of the lead that's receiving the presentation, and the velocity, the amount of people that are receiving that presentation. Those are the three key things that I think are most important, other than management and the product, which, you either have a good product or you don't.
Yeah, awesome. Hey, it's been an absolute pleasure, Sean. Thank you so much for joining and
Thanks for
giving us
having
all
me.
your information. And I think it's been great. I've learned a lot. Real quick, if people want to reach you, get a hold of you, what's the best
You
way?
can go to my website, which is medxcap.com. That's www.medxcap.com, or you can email me at smurphy at medxcap.com. Or you can find me on LinkedIn, Sean Michael Murphy. You'll see my profile and I reply personally. I don't have an AI assistant yet doing that. Maybe
I can
Daniel
help
can
you with
hook me
that.
up. Yeah, maybe Daniel can hook me up with that after the podcast. But I will respond to you, and maybe we can put our heads together and find something that works for you.
Awesome, Sean. Thank you. And congratulations on all your success and best of luck to you in the future.
Thank you, and it was good catching up with you, Daniel.